Let's start with a number, $50,000. That's not the price of a starter home in a rural town. That's not a year of private college tuition. That's not some exotic luxury product most people will never need. That is the average transaction price of a new car in the United States right now. In September of 2025, the average American new vehicle crossed $50,000 for the first time ever, and the industry barely blinked. And yet, somehow, people are still buying them. Or at least they're signing the paperwork and hoping for the best. Because here's the thing, the car market in America isn't just expensive right now, it's broken in ways that most people aren't fully seeing until it's too late. And by too late, I mean until the repo man shows up in the driveway at 6 in the morning and your car is gone before you've had your coffee. This video is going to walk you through exactly what is happening in the auto market right now. Not the version the dealerships want you to hear, not the manufacturer press releases about record demand and exciting new model years. The actual picture, the prices, the payments, the loan terms that are quietly destroying household budgets, and the default and repossession numbers that should be the headline of every financial news segment on television. We're going to cover a lot of ground, so let's move. Start with the sticker, because the sticker is where all of this begins. According to Kelley Blue Book data, the average transaction price for a new vehicle hit $50,080 in September of 2025. That's not MSRP. That's not the inflated window sticker price designed to give you the illusion of a deal when the salesman comes down a little. That's what people actually paid, the real number, and it set an all-time record. Now here's where it gets important. That number doesn't tell the full story on its own. You have to hold it up against what American households actually earn. The median U.S. household income in 2024 was $83,730. So you are looking at a situation where the average new vehicle costs nearly 2/3 of what the typical American family brings home in an entire year, before taxes. And the old rule of thumb, the one financial advisors have used for decades, is that you should spend no more than 10 to 15% of your monthly take-home income on a car payment. For a household at the median income, that's somewhere in the range of $600 to $900 per month, which sounds like it might just barely work, until you see the actual loan payments people are carrying. We'll get there. But the price itself isn't the only problem. The composition of what's being sold is just as important. Manufacturers have quietly gutted the affordable end of the market. Entry-level vehicles under $20,000 have essentially vanished from new car lots. The sub-$20,000 new car is effectively extinct outside of a handful of rare base trims that dealers rarely stock because the margins are too thin. Instead, automakers have pushed the lineup upward, toward trucks, SUVs, luxury crossovers, and high-trim configurations that happen to carry much fatter profit margins. The result? A survey from Consumer Affairs found that the average American says they're willing to pay about $21,310 to $22,090 for a new car. The actual average transaction price is more than double that. Only 40% of buyers say they can find something in their budget when shopping for a new vehicle. The market and the buyer are living in completely different realities, and the gap is only getting wider. So if you can't pay $50,000 in cash, and the overwhelming majority of Americans cannot, you finance it. And this is where things start to unravel. The average monthly payment on a new car in 2025 is $748. For used vehicles, it's around $532 to $537. And before you think that $748 sounds manageable, consider what comes with it. That payment assumes a loan amount of roughly $42,000 to $43,000, stretched over about 69 months, at an average interest rate of around 6.37% for new vehicles, and that's for buyers with solid credit. If your credit score is in the near prime range, between 601 and 660, you're looking at an interest rate closer to 9.57% on a new car. And if you're shopping used with subprime credit, that rate can hit 19.42% or higher. You're not buying a car at that point. You're renting money at an extraordinary cost and getting a vehicle as a side effect. That is a mortgage-sized obligation for a depreciating asset that loses roughly 20% of its value the moment it leaves the lot. And here's the thing that should concern everyone who is watching this. Buyers have been conditioned to focus entirely on the monthly payment rather than the total cost of the vehicle. Dealers know this. Finance managers know this. The industry has built its entire sales process around one question: what can you afford per month? Because when the conversation lives there, you stop thinking about how much you're actually paying for the car, how long you'll be paying for it, and how much interest you're piling on top. Which brings us to the loan term crisis that's quietly happening in the background. In Q1 of 2025, 84-month auto loans, that's 7 years, reached an all-time high, accounting for nearly 20% of all new vehicle financing. 1 in 5 new car buyers is now committing to 7 years of monthly payments on a vehicle. To put that in perspective, in 2019, only 13.4% of buyers were taking on 84-month terms. 6 years later, that number has grown to nearly 20%. And it's not because buyers got more financially adventurous, it's because the payments became mathematically unmanageable without stretching the loan longer. Think about what a 7-year loan actually means in practice. The average new vehicle depreciates at a rate that outpaces most people's loan payoff schedules, especially in the early years. By the time you're 3 or 4 years into an 84-month loan, there's a reasonable chance the car is worth less than what you still owe on it. You are, by definition, underwater. You have negative equity. And if something happens, job loss, a medical bill, an accident, and you need to sell or trade that vehicle, you can't just walk away clean. You're carrying a debt that follows you into your next purchase. And that's not a hypothetical. The numbers on this are stark. More than 25% of Americans trading in a vehicle right now are underwater on their existing loan. The average amount of negative equity being rolled into a new loan exceeded $7,000 for the first time on record. More than a quarter of those underwater buyers are rolling over $10,000 or more. Here's what that means in plain language. People are buying a $50,000 car, rolling $10,000 of leftover debt from their last car into the loan, and financing $60,000. While the car they just bought is already losing value from the moment they drive off the lot. They are starting $10,000 behind on day one and digging deeper. This is the debt spiral the industry doesn't put in the brochure. If new cars are unaffordable, the obvious answer is to buy used. And for a long time, that was genuinely good advice. Buy a 2- or 3-year-old vehicle at a significant discount, avoid the worst of the depreciation, and keep your payments manageable. That playbook still exists, but it's gotten a lot more complicated. The average used vehicle now sells for around $26,446. That's not a bad number in isolation, but remember, this is a used car. And the loan rates on used vehicles are dramatically higher than on new ones. The average used car loan is coming in at around 11.26% interest. If you're a near-prime borrower, that rate climbs to 14.49%. If you're subprime, you could be looking at 19.42% or more. Run the math on a $26,000 used car at 11% interest over 68 months, and you're looking at a monthly payment around $532. That doesn't sound catastrophic until you add insurance, which has surged dramatically in the last several years, maintenance on an older vehicle, and fuel. The total cost of ownership on a used vehicle isn't dramatically cheaper than it appears at first glance. And the Manheim Used Vehicle Value Index, the industry's benchmark for wholesale used car prices, showed prices rising 4.9% year-over-year in April of 2025, hitting their highest level since October 2023. The used car market got an enormous price floor installed during the pandemic years, and that floor has not fully collapsed back to where it was. The bargain end of the market, the $8,000 to $12,000 reliable used car that previous generations could count on, is increasingly difficult to find in good mechanical condition. The pandemic wiped out a generation of that inventory, and as new car production slowed, fewer vehicles aged into the affordable used car sweet spot. The escape hatch is smaller than it used to be, and for a lot of buyers, it's not really an escape at all, just a different version of the same problem. Here's where we get to the part of this story that the industry would very much prefer you not focus on. Auto loan delinquencies have been climbing steadily, and the numbers are now at levels we haven't seen since the financial crisis. According to data tracking 90-plus day delinquencies, that's the stage where a borrower is seriously behind and heading toward default. That rate hit 5.21% in Q4 of 2025. The long-term average for that metric is 3.57%. We are 46% above normal, and the trend line is pointing up, not down. For subprime borrowers, people with credit scores below 620, the delinquency rate hit 15.78% in Q3 of 2025. That means roughly 1 in 6 subprime auto borrowers was 30 or more days behind on their payment. That is a number that should be generating front-page coverage. And the repossessions are following the delinquencies exactly where you'd expect them to go. In 2024, approximately 1.73 million vehicles were repossessed in the United States, the highest annual total since 2009. Some estimates place the number even higher, near 1.88 million, depending on the data source. That represents a 16% increase from 2023 and a 43% increase from 2022. Nearly 2 million American households had their vehicles taken back by lenders in a single year. A car isn't just a consumer product for most Americans. It's the mechanism by which they get to work, take their kids to school, get to a doctor's appointment, and maintain basic participation in daily life. When the car goes, a lot of other things go with it. Auto loan defaults exceeded 2.3 million in 2024, and early 2025 data shows no signs of relief. The 60-plus day delinquency rate in Q1 of 2025 actually exceeded the 2009 peak, the worst point of the Great Recession. We are in historically significant territory here, and the mainstream conversation has not caught up to what the data is actually showing. Not every borrower is equally exposed to this, but the demographics of who is getting hit hardest tell a meaningful story. Younger borrowers between 18 and 29 are showing the fastest rise into serious delinquency. This makes intuitive sense. Younger buyers tend to have less financial cushion, shorter credit histories, and are more likely to have financed at the top of the market, buying when prices were elevated, interest rates were high, and loan terms were already stretched. But here's what's genuinely surprising in the data. It's not just subprime borrowers who are struggling. Borrowers in the average credit range, scores between 620 and 679, are also showing faster than expected rises into serious delinquency. This is not a story exclusively about people who had poor credit to begin with. This is bleeding into the middle of the credit spectrum. And the broader household budget context makes this make sense. The average American household spent $13,174 on transportation in 2023, about 17% of the average paycheck. When you factor in insurance costs, which have surged dramatically since 2020, fuel, maintenance, and the loan payment itself, car ownership has become one of the largest single line items in the typical American budget. It is competing with rent, with groceries, with healthcare, and in many cases, it's losing that competition. The picture that emerges isn't one of irresponsible borrowers making bad decisions in isolation. It's a market that has priced itself far beyond what median incomes can sustain, with a financing ecosystem that is compensated for unaffordability by lengthening loans, lowering standards, and kicking the problem down the road, until the road runs out. To understand why we are here, you need a quick timeline. Before the pandemic, new car production was humming along at a pace that kept dealer lots stocked and gave buyers negotiating power. Automakers were already moving toward higher-margin trucks and SUVs, but the affordable end of the market still existed. Then COVID hit, supply chains shattered, and semiconductor shortages gutted production. New vehicle inventory collapsed. Dealers, for the first time in a generation, had more demand than supply, and they responded the way any business would. They charged more. Markups above MSRP became normal. Cars were selling for $5,000, $10,000, $15,000 over sticker, and buyers paid it because there was no alternative. Simultaneously, during the low-rate era of 2020 and 2021, cheap financing made high prices feel manageable. A $45,000 car at 2% interest is a very different monthly payment than a $50,000 car at 7% interest. When the Federal Reserve raised rates aggressively starting in 2022, those payment calculations got dramatically more painful. But prices didn't come down to compensate. Automakers and dealers had recalibrated to a higher price floor, and they weren't going to give it back voluntarily. The net result is a market where prices have risen roughly 40% since 2018. Interest rates have more than doubled for many borrowers, and wage growth, while real, hasn't come close to offsetting both of those forces simultaneously. Something had to give, and what gave was the borrowers at the margins of affordability. First, the 20/4/10 rule is worth understanding, even if the market makes it harder to hit than it used to be. Put 20% down. Finance for no more than 4 years. Keep total car-related costs, payment plus insurance, under 10% of your gross monthly income. If the car you're looking at fails all 3 of those tests simultaneously, you need to have a serious conversation with yourself about whether the purchase makes sense. Second, be extremely cautious about loan terms beyond 60 months. The 84-month loan feels like a solution to unaffordability, but it's actually a way of transferring the problem into the future at additional interest cost. You will almost certainly be underwater within the first 2 to 3 years of that loan. If life changes, and life does change, that negative equity becomes a trap. Third, if you're shopping used, price the total cost of ownership, not just the purchase price. A $20,000 used vehicle with an 11% interest rate and high insurance costs may not be dramatically cheaper than a carefully selected new vehicle with manufacturer incentives and a lower rate. Run the actual numbers before you decide. Fourth, and this is the one most people skip, get pre-approved financing from a bank or credit union before you walk into a dealership. The dealer's finance office is not your ally in this process. They make money on the spread between the rate they can get and the rate they offer you. Come in with your own financing and treat dealer financing as a competing offer, not a default option. And fifth, if you are currently in a situation where your payment is becoming difficult to manage, the worst thing you can do is ignore it and hope it resolves itself. Contact your lender early. There are more options available before default than after it. A repossession doesn't just take your car, it damages your credit for years and makes the next purchase even more expensive. Here's the thing that's worth sitting with as we close this out. The American economy has been built around the assumption of car ownership in a way that almost no other country matches. Public transit is limited or non-existent in vast swaths of the country. The suburbs, where a significant portion of the population lives, were literally designed around the personal vehicle. You cannot participate in normal American life in most places without one. That makes the car market structurally different from almost every other consumer market. You don't need a vacation, you don't need a new TV, but for most Americans, you absolutely do need a car. And when a necessity becomes this expensive, and the financing ecosystem built around that necessity starts showing the kind of default and delinquency numbers we're currently seeing, that's not a story about consumer behavior. That's a story about structural failure. The manufacturers have bet heavily on the high end of the market. Trucks and luxury SUVs dominate production because the margins are better and wealthier buyers exist in sufficient numbers to keep the lines moving. The middle and lower end of the income distribution, people earning $60,000, $70,000, $80,000 a year, are increasingly priced out of the new car market entirely and pushed into a used car market that has its own affordability and quality challenges. That is not a market in equilibrium. That is a market with a growing structural imbalance, and the delinquency numbers and repossession figures are the first visible symptoms of where that imbalance leads. Whether prices eventually correct, whether automakers eventually reintroduce more affordable vehicle lines, whether interest rates ease enough to change the monthly payment math, none of that is certain. What is certain is that the current trajectory is not sustainable for a large portion of American households. And if you're one of those households trying to figure out your next move, the best thing you can do is know exactly what you're dealing with before you walk into a dealership and sign something. Because the numbers are right there, you just have to look at them clearly.